All right, welcome everyone. Thanks for tuning in to this episode of the Hawaii Retirement Show. Today's guest, we have Sean Mullaney. Sean is a CPA and advice-only financial planner and the president of Mullaney Financial Tax. He is the co-author, along with Cody Garrett, of the recently released tax book, Tax Planning to and Through Early Retirement. Sean writes an award-winning blog on the intersection of tax and financial independence, the FI Tax Guy, and also has a YouTube channel with a lot of great content on there. I always take a listen and check it out from time to time. But yeah, we're happy to have you on, Sean. I'll turn it over to you if you want to tell us a little more about who you are, what you do, whatever you'd like to share.
Yeah, aloha. Jason, thanks so much for having me here. I really appreciate it. I'm a financial planner. I'm a career changer, actually. So I was an accounting major in college, had a corporate tax career that lasted up till age 40, and then made a shift into personal finance and set up my own firm in 2019, got that going. And I've been doing, financial planning now for 6.5 years, working with individuals. And I'm very interested in tax planning. And a lot of my interests have recently gravitated towards the years right before retirement, the years right after retirement, and definitely a bit of a focus on early retirees. I do a lot of content for members of the financial independence or FI community. So that's a natural marriage between financial independence content, early retirement content. And my most recent large project is a book with Cody Garrett, like you mentioned, Tax Planning to and Through Early Retirement. So we dive deep into all sorts of stuff, building up wealth, thinking about the early retirement years, premium tax credit, potential Roth conversions, other drawdown planning. Mm-hmm. So yeah, really looking forward to our conversation here today, Jason.
Awesome. And where are you joining us from? Are you in California?
Yes. So I live in Woodland Hills, California, which is part of both Los Angeles City and Los Angeles County, the northwest part of LA, sometimes called the West Valley. And I'm a New York native. You can see behind me, I've got a little Shea Stadium picture up there, or artwork. I was born in Flushing, Queens, grew up on Long Island, and then as an adult spent 15 years in Arlington, Virginia, outside of Washington, D.C. So I'm mostly an East Coast guy, but I moved out here in 2017. So it's been a little over 8 years that I've lived in Los Angeles.
Gotcha. Very cool. And we talked a little bit right before we jumped on here. You have been out to Hawaii before, right? I think you mentioned you haven't been to Oahu, and I can't tell because it's a little dark. But is that did you bring on your aloha shirt for the conversation?
This is a Hawaiian shirt. It's blue and sort of got like the palm tree effect going. And yeah, on the camera it looks a little dark, so it's not the best one for this purpose. So my wife and I did our honeymoon on, let's see, we started in Maui, then we did Big Island, then we did Kauai. And since then, we've made 2 return trips. One was to Maui in 2019. One was to the Big Island in 2022. Sort of feel like we're overdue. I feel like my wife, created a monster by doing the honeymoon in Hawaii. I'd never been, growing up on the East Coast, Hawaii's a bit of a distance.
Sure.
And just not the easiest vacation. And I think my wife created a bit of a monster in terms of, I'm very fond of Hawaii as a vacation destination. And it's now been over 3 years. So we're thinking about it maybe for 26, not sure yet. But yes, I'm very fond of Hawaii, and Oahu's got great stuff too. And so at some point, I'm sure we'll get there as well.
Awesome. Yeah, and I actually appreciate the subtlety of your aloha shirt. Oftentimes, I don't want to lump everybody in, but a lot of the mainlanders come over and they think the point of an aloha shirt is to be as loud as possible with it. And that's not the case.
Yeah, I got this, years ago at like a Macy's, right? So, this is not. I brought this on our honeymoon. I remember I wore it at the end of our honeymoon. I may have forgotten the other 2 trips. One of the trips we did is part of the trip, Volcanoes National Park. So this isn't exactly a hiking shirt, as you can imagine. But yeah, I mean, it's Hawaii is just a great vacation destination.
Awesome. Well, I appreciate you coming on. I have my copy of the book here.
Thanks for buying it, Jason. I appreciate that.
And you know what? I didn't know what to expect, so I purchased it, and I think I even wrote you. I said, "Yeah, I'll try to read it through before I before I have you on. And as I started looking at it, it's kind of, in my opinion, maybe it's just because I'm taking the advisor viewpoint here, like a field guide. You know, it's not necessarily a. I mean, you can do the page turner from front to back, but it's a lot of good insight, and I look at it as a great reference book, right? And now I can only imagine the challenges of taking on this kind of project, and what I mean by that is tax planning can be such a wide swath of things, and to kind of try to wrangle it up into a book. I mean, it must have been challenging, right?
It was. So, a few thoughts. One, having a co author was enormously helpful. So, Cody Garrett is a financial planner. He's based in Houston, Texas, very well known online.
Hmm.
And he and I are very like minded when it comes to the big picture of tax planning, too, with the early retirement. So, and we've known each other for years. And so it was a natural marriage in terms of a colleague I could work with, and we could come together on the big picture. We even have little segments where maybe it's called Sean's take or Cody's take, where maybe there's a little something where Cody has a particular emphasis or I have a particular emphasis. But it was so helpful with that. It was helpful to do it through the lens of retirement planning.
Hmm.
So we barely touch on things like S corporations. You know, there are things that we just don't touch on because we say, all right, retirement planning has so much from a tax perspective. And then I do want to give a shout out to a practitioner, a woman named Denise Appleby. She's very well known in the retirement world, right? IRAs, 401ks, qualified plans.
Hmm.
And she was nice enough to do a technical review on the IRA and the qualified plan. That's the fancy term for 401ks and those type of workplace plans.
Right.
All the IRA and qualified plan technical stuff, she did a technical review for us, which was very, very helpful. She was most gracious with her time and attention. So there'd be a few things that I would say certainly helped us in our process. And, you know, Jason, you struck something. This book is not necessarily designed to be read cover to cover.
Hmm.
So I'll give you an example. There's an entire chapter in this book on rollovers of retirement accounts.
Hmm.
Well, maybe you're 40 years old and you're like, I'm not going to retire for 15 years. And I have my Roth IRA at home. I have my 401k at work. I'm not looking to leave a job. Okay. The rollover chapter, as wonderful as we may believe it is, probably just doesn't really speak to you. So
Right.
if you want to skip over the rollover chapter, that's okay.
Right.
Skip
Right.
over it. And if you find out in a year, oh, I'm now leaving to go to another employer. Oh, maybe I want to start thinking about rollover retirement accounts. That's fine
Right.
too. So it was a challenge. I'm glad we did it, and I'm glad it's getting out into the world now.
Yeah, I think it's a great book. I think for do-it-yourselfers, for people in the field, it's a great book. I'm curious your thoughts on, the tax law, the legislation. It changes from time to time. Recently, we had the big beautiful bill, right? The one big beautiful bill, Secure Act 2.0. I think for the most part, a lot of this stuff that's the content that's in there is kind of evergreen. There's always going to be the challenges of you never know what's coming down the pipe, in 5 years, 10 years, or what that landscape will look like. So I'm sure that had to have been kind of in your mind as you went about it.
Well, so it's interesting you say that, Jason. So we knew there was going to be some tax law change, but we could write a lot of the book before the final bill. Why? System and tax return work. What's the purpose and what are the basics of an IRA or a 401k? So that stuff wasn't going to change. A few other things weren't going to change. Rollovers, like I mentioned, there's nothing in the new bill about rollovers. Early withdrawal penalty. We have a whole chapter on the exceptions to the 10% early withdrawal penalty, which are very relevant if you're thinking about an early retirement. Nothing in the one big beautiful bill touched that. So we could
Right.
work on all that stuff while doing this. And then directionally, once the House bill came out, which I believe was in May, directionally the bill never changed. Now there were tinkering, there were this little thing, that little thing, a third little thing. Those things all changed, but we were able to write the book in an environment of uncertainty. And in fact, that's a point we make in the book, is that the next time there's one tax law change, that doesn't invalidate the book,
Right.
right? Now, it might change some of the details, but general themes emerge. And one of those themes tends to be that based on the electorate and based on recent history, Congress tends to favor retirees. Retirees tend to vote, and that sets up an environment where retiree taxation tends to be favorable. And then we also talk about a lot of good planning that early retirees and even conventional and late retirees can do to help manage their tax bill.
Right. Yeah, no, I think you guys knocked it out of the park. From what I've seen so far, yeah, it's you've done a great job at doing that. Um,
Thanks for your kind words, Jason. Really appreciate it.
yeah. Let's so for those listeners out there who might be less familiar with, okay, what are these guys talking about tax planning? Um, there's a general statement out there, which I think is not entirely true, but you hear, your CPA or tax preparer, they're just focused on this year, which I think some of them are, but some of them, I'd like to give them the benefit of the doubt that some of them are looking forward thinking. But tax planning is a lot of that forward thinking kind of mentality. And it's the concept of how I see it, and I'd love to hear your thoughts, is paying the lowest tax bill across your lifetime rather than year by year. Even though in some years you might pay a lot of tax, right? It's not like, unfortunately, there might be years where you just take a massive tax bill, but if there's a reason for it and forethought, maybe that benefits you down the road, right?
I think that's right, Jason. You want to think about what are the ways we can increase our chances. By the way, this is all planning, so it is all subjective.
Hmm.
And we don't 100% know the future. Now, Cody and I make an argument that we actually know a lot more about the future than you might think. But that said, there's no 100% guarantees. So what you're looking to do is maximize the chances that you will lower your total lifetime tax liability regardless of future outcomes. That's basically all we're doing here. Now, we believe there's a lot of good tactics in play at all phases of our life. Now, yes, if we're 90, there's not as much, but even there's some tax tactics at play. But, especially for the reader that we're aiming for, I'll give you one example. We're talking about, it's called tax planning to and through early retirement. We defined early retirement as before Medicare enrollment, which is the first of the month you turn 65. Well, if you do some math, today's early retiree, the oldest early retiree at this moment in time is 65 years old. They were born in 1960. That gives them a good advantage. Everyone born in 1960 and later doesn't have to take the first required minimum distribution, they call it an RMD, until age 75. That's a very good advantage that those of us born in 1960 and later have. And that's just one thing that's changed in the recent years. And so part of the reason we wrote the book was because the landscape has changed a little bit. And so we wanted to factor that into our analysis. And we hadn't seen a good source that had done that had folded in some of these actually pretty big changes in the last few years, and including the changes in the One Big Beautiful Bill. So it was time to strike while the iron's hot. But you're absolutely right, Jason. It's not about, can I zero out my tax return this year? Can I find all these deductions and, this one-time big deduction and great, look at me, I saved on all these taxes. Well, okay, fine. That might be valuable. I'm not here to say that that's necessarily the wrong answer, but it's really about how can I play my cards so that over the course of my life, my working years, my early retirement, my later retirement, I maximize the possibility of limiting my total lifetime tax.
Sure. And I think sometimes for those, right, we're all talented and we're all smart at different things, right? You put somebody like, you start talking chemistry to me, I'm not going to be, equipped for it. And I think for a lot of people who aren't really in this space, you might hear tax planning and think there's got to be all these tricks that these kind of hide and slide tricks that people are doing to lower their tax bills. And I just think in general, it's not that way. And actually, it can be very complicated, and certain cases do take a special skill set, highly analytical kind of look at things. But I think generally most people can do a lot of tax planning on their own through some understanding through your book like you have here. It's not necessarily reserved for tax experts. And I think just maybe you can't do the final, 0.2% of optimization, but you might be able to get yourself a lot of the way there, right?
I think that's right, Jason. No one needs to be a tax expert, and you certainly don't need to be an expert in the Internal Revenue Code. And I wouldn't hold myself out as an expert in the Internal Revenue Code because it's so massive and so huge. But there's all, and one of the underlying themes of our book is simplicity tends to work from a tax perspective. So I'll give you just a quick example. We live today in a low yield world. So that's a fancy way of saying if you own $1 million of a index fund that has U.S. equities, say, broad based, the dividend yield on that thing in today's environment, and I haven't checked the most recent numbers, could be 1.2, 1.3%.
Mm-hmm.
So that means that $1 million holding generates 12,000, 13,000 of income. Boy, that's a pretty good way to structure one's affairs. I'm not giving investment advice in this podcast, but it is an interesting way of structuring one's affairs when we're thinking about what should we hold, especially in a taxable account. And by the way, 90% of that's probably going to be qualified dividends. So it's going to have an even lower tax rate or potentially a 0% tax rate in retirement, depends on your circumstances. But that's a simple way of arranging one's affairs that it turns out tends to be very beneficial from a tax perspective. So I think simplicity tends to win out versus all these bells and whistles. And I think the more bells and whistles you have to think about is like, well, okay, we're increasing friction, maybe expenses, and we may be hurting ourselves when it comes to tax planning.
Mm-hmm. Yeah, great points there. I had Andy Panko, who I'm sure I think you've talked to him before. I've had him on, and I like the way we kind of talked about it in that tax planning shouldn't be the main focal point of retirement planning, right? It's the optimization, and you often hear the saying, which I'm sure you've heard hundreds of times, don't let the tax tail wag the dog, right? And so on the other end, right, there's those who are unfamiliar with tax planning, and then you do have this cohort out there who are just tax planning optimizers who are just trying to dial it in. And I would say, there can be a downside to going too far to the other side of the spectrum. But that's like what we come back to, like you said, the simplicity, right? I mean, you don't want to take this thing and run with it to where you're running yourself crazy trying to dial these things in.
I think that's right, Jason. I think so. One thing I've noticed just sort of in my travels in the personal finance space is sometimes the availability of a tactic is substituted for the desirability of a tactic. So people read about the latest and greatest, whatever it might be,
Right.
Bitcoin, annuities, IUL, like just name your like shiny object of the day. And look, I'm not here to say any of our listeners should or should not be in those, but let's not confuse availability for desirability. I think we have to step back and say, well, wait a minute. Yes, this may be available, but am I already on a good financial plan? And are there simpler, lower cost ways of doing things? And I think a great objective in our personal financial lives is just limiting friction and thinking about another thing you could think about is next generation. And I'm not even talking about tax planning for the next generation. I'm just talking about when the next generation inherits, these assets, how easy is it going to be for them to manage those assets and to get those assets after my death? And the harder it's going to be, or maybe that asset goes away because of its terms and conditions at your death, the harder or more likely it is that that thing goes away or is harder to access, the less likely it is to be desirable for you. It's a great substitute indicator. Like, oh, if this is going to be rough on my heirs, maybe this isn't the best thing for me. You got to do your own analysis, but I'm a big fan of not confusing availability for desirability.
Gotcha. Yeah, I love that. Okay, so let's shift gears here. I thought it'd be fun to kind of let's go through 10,000 foot level, some tax planning opportunities and ideas and concepts that somebody might experience throughout their life, right? Because I love the title To and Through Retirement, right?
Yes.
So let's start in the accumulation phase. Somebody's in their 30s and 40s. At this time in somebody's life, you got children, you're buying a house. So you're going to have some college savings considerations, maybe some health savings accounts. And I think the big one is, that age-old question, and it's so simple, right? But should I be putting my retirement funds in Roth or traditional, right? And that's a really hard one, especially I think the further you're out from retirement. Now, if you're a high earner, right, there's rules, generally you're going to lean towards that tax deduction now. But there is a lot of variables there. And then to piggyback on that before I turn it over, sometimes you hear it's good to have a good mix of different taxable accounts, right? So your brokerage accounts, your pre-tax, your traditional assets, and some Roth, for the sole reason of options later, right? So there's kind of that sentiment that you hear often too. So what are your thoughts there on the accumulation phase, your 30s and 40s?
Yeah, so a few thoughts there, and we have multiple chapters in the book about this, but I want
Sure.
to unpack a few things. First of all, I like how you started that question. This person now has children to worry about, and they've got a house to worry about. This
Right.
person, even if they're crushing it, and yeah, there's going to be a handful of them. They're both in tech. The company went to the moon. Okay, they're just crushing it. They're fine. But even if they're doing really well, their financial future is not secure. So it's that time in their life, vis-a-vis other times in their life, is not a great time to park what I call tax risk.
Mhm.
That is not a great time to be paying a lot of taxes because one, that person, they got kids at home. That's an important consideration. Two, they may be in their highest earning years depending on their career.
Right.
So, if you're paying more taxes, you found a way to pay more tax when you pay more tax. That's not
Mhm.
so great.
Right.
So let's come to traditional versus Roth. I say let's do both,
Mhm.
but we got to be intentional about that. So when I say let's do both, I say let's optimize for known trade offs.
Mhm.
And how do we do that? Let's take a look at our workplace 401k. If
Yeah.
we're under 50 years old, in the year 2025, the max is 23,500, and it can be in most plans traditional and or Roth, a
Mhm.
combination thereof. Um, every dollar we put into the Roth 401k is a sacrifice tax deduction at our highest marginal rate. That's an interesting trade-off profile. We'll come
Mm.
back to that. What about at home? Okay. At home, that same person almost certainly cannot deduct a traditional IRA contribution. So if they decide to do the Roth IRA contribution, either through an annual regular contribution or a tactic referred to as the backdoor Roth, either one of them, they have not sacrificed a tax deduction for the Roth money at home.
Mhm.
Most likely, they didn't qualify to deduct a contribution to a traditional IRA, just how the rules work in today's environment. So I say, why not focus on getting the highest value tax deduction we may have in our entire lives,
Mhm.
or certainly close to it, deduct into the traditional 401k, while at home we take the contribution into the Roth IRA either through a regular annual contribution or a backdoor Roth. We've optimized for the trade-off profile. We didn't contribute to a Roth 401k when it sacrificed a tax deduction, but we did contribute to a Roth IRA when it didn't sacrifice a
Mhm.
tax deduction. And then I'll just put in a little plug for the taxable account, which some people don't like, but
Mhm.
I tend to actually favor them. They tend to be a very good first spend asset in retirement. Qualified dividend tax rates are low today. So in the book, we call it the compelling three, essentially traditional 401k at work, Roth IRA at home, and then maybe some taxable brokerage accounts at home as well. That tends to be my favorite approach. Look, you got to do you, and there could be bells and whistles. There could be some, the HSA, like you
Right.
referenced, that could be a good bell and whistle. There could be something called the mega backdoor Roth.
Mhm.
Tech sector employees often have this. That could be a good
Right.
bell and whistle. There could be a governmental 450, other things out there. But, as a general educational principle, taxable brokerage account.
Sure. Okay, so let's head over to the transition phase, 5 to 10 years before retirement, or even if it, I mean, there's no rules around this. You can frame this however you want. You could say 5 years before, 5 years after retirement. I always like to look at it kind of 10 years leading up because you don't want to start looking at your retirement aspect of tax planning when you're in retirement, right? There's some things a lot of times people can do leading up to retirement there, and things start to
Yes.
get a little clearer. And this is also, and this is why I love retirement planners. I think there's just so much value to be had there in the financial space because there's so many decisions to be made. There's Social Security decisions, right? I mean, there starts to be, you can see what RMDs become a little clear, and you can start to make decisions around that kind of stuff. So yeah, and also at this time, maybe, this is a time when maybe somebody's parents pass away. There might be an inheritance coming your way, right? That could provide planning opportunities. So what's your thought here? The transition phase to me, I mean, that's the one I really I covet, and I think so much going on, so much you can do there.
Yeah, and so one thing I'll mention is the third of the compelling three, the taxable account. Now, when we're closer to retirement, we tend to be in our higher earning years, and we tend to be in a spot where we have more free cash flow because maybe the kids are out of the house at this point, and so we're not, paying for them. We're just more established in our lives. We're not buying new things all the time as we get a little older. We don't really care if the couch is out of date, that
Right,
sort of
right.
thing. So this could be the time for a lot of folks who get to, particularly in early retirement, but it can even be a conventional retirement. This can be the time where we really build up those taxable accounts. Now, we should still have the cash flow to be able to max out the traditional 401k and maybe a Roth IRA too. But the taxable account tends to be much more accessible at the beginning of our retirement. And why do I say that? Because it makes such a great first spend asset in the beginning part of retirement. People get to retirement, they're like, what should I spend? I have no idea. Like, do I do a 72T if I'm under
Right.
59 and a half? Do I just start taking from my traditional IRA? Do I take from my brokerage accounts? My favorite tactic is to take from the brokerage account for two reasons. Well, it's actually more than two reasons, honestly, but I'll just give you two reasons right now.
Sure.
One is basis recovery. So let's say you get to early retirement and you're spending $100,000 a year. Just use a round number, and so you go into your taxable brokerage account. You have ABC mutual fund. You sell 100,000 of that. Well, is your taxable income 100,000? No,
Mhm.
because of something called basis recovery. You have a historic cost in that mutual fund. You bought it for a certain price. Maybe there's some reinvested dividends in there. So on that 100,000 of spending, your taxable income is 100. It might only be 70 or 60 or 50 or 40 because you have basis that offsets the gross proceeds. So that's very helpful as a first spend asset. And then the second thing is the very favored long-term capital gains tax rate. So there's sort of two types of income. There's ordinary income, which is almost everything, and then there's long-term capital gains income, which is literally long-term capital gains, those assets we sell that we own for over a year, and then these qualified dividends.
Mhm.
Those two things get this very favored tax structure where if you could keep your income low enough, the 2025 number is 96,700 of taxable income for a married couple. You can get those things at 0%. So you marry basis recovery with the 0% long-term capital gains rate, you might be at a spot where you could have zero federal income tax in the first few years of your retirement by living off these taxable brokerage accounts. And your income and your tax situation might be so favorable, you might want to add on a Roth conversion to
Mm.
that picture. Now, maybe you don't if premium tax credit's a particular consideration. But it gives you such an opportunity to manage income in the first part of retirement. And when we spend down those taxable accounts first, you know what's still growing? Our traditional retirement accounts and our Roth retirement accounts. They're growing. Now, look, markets can be down some
Sure.
years, right? There's no guarantee. But when we're not taken out of those things, the odds are over time, those things tend to grow. So we're growing our tax, favored assets in a sense, and we're diminishing those things that produce dividends and interest that show up on our tax return that we can't control unless we sell. So I really like, in the years that are closer to the retirement date, having a bit of a priority in these taxable accounts because they're great first spend, and we tend to have the cash flow to fund them in the
Mhm.
late part of our career, and then they're great first spend assets at the beginning of our retirement.
Sure. Yeah, and like you said, now if somebody has, a pension, well, there's going to
Mhm.
be income right off the bat if you're claiming, right? And then there is those opportunities with Social Security that can be often overlooked, and it's not always the best situation. Social Security is an interesting one because you have the spousal benefits, you got survivor benefits to consider. You have a lot of things to consider there, but sometimes what's often overlooked is delaying this Social Security because it is a valuable asset. It's that steady stream of lifetime income, even though there's a lot of fear and speculation about it. Uh,
So,
yeah,
so Jason, part of the reason you write a book like this is to improve your own knowledge and thinking. And I think working with Cody, I did that. And one area where I've become even, look, just because I favor something doesn't make it the automatic right answer. You got to do your own analysis.
sure.
But one area that I've become more of a fervent advocate for, in a general sense, is delaying Social Security claiming.
Mhm.
And it has to do with a number of factors. One of them is tax benefits. So if we can delay claiming our Social Security, if we can afford it,
Mhm.
we're keeping that ordinary income off our tax return for longer.
Right.
That gives us more tax planning flexibility in our mid to late 60s to either just manage traditional IRAs or even just or do affirmative very low or no tax Roth conversions. So that's one reason. But the benefits there are more benefits out there. So
Mhm.
one of the benefits is volatility. So if you think about, a 65-year-old married couple and they're retired and they're fine, right? They've got their portfolio, so they've got stocks and bonds spread out through what, taxable accounts, traditional Roth, HSA, whatever it is. And stocks and bonds are generally to some degree volatile, right? They're subject to all sorts of risks. And look, we use diversification to help modify that. We don't put, generally speaking, we don't put all our eggs in one, find this tech company and put it all in there and let it ride. No, we diversify with index funds. Generally speaking, we use, different sectors, different geographies. Okay, great. But even with that diversification, they're still volatile.
Right.
Bonds are volatile. It's all volatile. Cash, even inflation risk. Social Security, by comparison, is a relatively non-volatile asset, in my opinion. So what I mean by that is we go to SSA.gov, we can get inflation factors, and it's inflation adjusted. Generally speaking, it's relatively non-volatile.
Mhm.
So if we delay claiming that Social Security, we're going to have to spend down our portfolio assets in our 60s. We just have to. We got to fund our life somehow.
Right.
So we're going to spend down the volatile assets to some degree while we're increasing our future Social Security every year by delaying, right? The audience may be familiar, varying percentages, but especially in those last 3 years, it's 8% a year. You
Mhm.
get an increased payment every year by delaying. You can only delay to age 70 and then you have to
Right.
take it. But what we've set up is somebody going into their 70s in a less volatile place in their life because they're less reliant on the portfolio assets because they spent them down because they had to live on something, and they're doing better, or they have a higher monthly check from Social Security, and that's a lot less volatile. So I think there's real benefits in delaying. Now,
Mhm.
look, first of all, if you need it, take it. Okay.
Sure.
If you need your Social Security, take your Social Security. And by the way, your tax situation is going to be fine. If you need your Social Security, almost certainly your tax picture is very late, just the way
Right.
the rules work. I'm not here to say don't take it if you need it. But if you don't need it, if you have taxable accounts, even traditional retirement accounts, boy, I would and they're good enough to fund your lifestyle. I would consider delaying. So that's just sort of my take on it. I don't know, Jason, if you find wisdom or ignorance in that take,
No,
but
no,
that's my take.
I share the sentiment. I do. And I think it's hard because for the average person out there, you hear a lot of negative speculation about Social Security, running out, or there's problems with it, or there's I think most people, I would say, and maybe this falls into that the marshmallow test, right? The delayed gratification, but most people, I think, approach retirement and say it's kind of like, well, I want to get everything I can because I don't want to miss out, right? The only problem with that way of thinking is you're not looking at the downsides to, well, what if you live till 100 and whatever? I mean, that's something to consider too. It's so far out that I think most people tend to lean towards I want to get everything I can now. I want all the benefits now because I just don't know. And it's fair. There's fear there, right? Of
Yeah.
making the wrong decision.
Well, and people, so if you think Washington is not going to pay out something like 100 cents on the dollar on Social Security, you're making a heck of a prediction. So our government, look, I am not a fan of high debts and deficits, right? I don't mean to make this a political conversation, but I myself am very, I look at that very unfavorably, right? I'm against running high debts and deficits. But this idea that that they have the power to print money and they have the power to borrow, and they'll do that for everything else in the federal government. They'll do that for the cleaning the carpets in the White House and the military spending and all that stuff. But they're not going to do it for one of the most popular programs in the world, Social Security. That's a big prediction you're making.
Right.
I just, because essentially they have not borrowed for Social Security as of now. Now, yes, in whatever it is, 2033, they say, you'll hear this headline, Social Security is going to run out of money. That's false.
Right.
What it means is the overages that have been paying the current debts or the current annual deficits in collections, that will run out. So in theory, Social Security would only be 70% or 80% funded. Mm-hmm. Well, they never look at that. They never look at cleaning the carpets in the White House and the military spending that way. Right. Those things don't generate any revenue. So they're all deficit, but they never talk about, look at the military running these huge deficits. They never talk about that, but they talk about, Social Security is running these huge deficits. So I think at the end of the day, look, could they make some tweaks and it's going to be 98.5 cents on the dollar? Sure. They may nickel and dime people a little bit, but much more than that, I just don't think is politically viable. And, oh, by the way, Congress has plenty of tools, whether you like them or not. I'm not here to say, they can cut other spending. They can print money. They can issue more debt. There's plenty of tools to make Social Security claimants whole. So I think if you're predicting that Social Security is going to get cut by 20 or more percent, you're making a prediction that the politicians are going to turn on a dime against their own interests. That's a heck of a prediction. I'd like to see some evidence that sort of backs up that prediction.
Yeah, great points. And what pops in my mind is with a lot of this stuff, Social Security is just what we're talking about now, but the tax planning, the distribution planning, the retirement planning, the number one variable that could solve all the questions, not all the questions, right? Tax planning, there's a lot of speculation, is how long are you going to live and how long is your spouse going to live, right? And that's kind of the key part of distribution. Like if I were to come to you, Sean, and I said, well, I know I got exactly a 18-year retirement. Well, that solves so many, issues for how you're going to map things out. The problem is we don't know if it's 10 years. We don't know if it's 30 years. We don't know if you have massive, long-term care expenses. There's just so many of these variables. And that just popped in my head with Social Security, right? Because it can be a simple math equation if you know your life expectancy, right?
Oh, 100%. You have to think about what is likely. But the other thing, I think people, so sometimes we focus too much on the numbers and the inefficiencies, and we should back. As long as you go to work at some point in your life, you're going to have to pay some taxes. Okay. So there's a tax risk there. And the whole traditional and Roth system allows us to park tax risk, meaning in theory, what you could just do is just max out your Roth 401k at work during your working years. And now you've put all the tax risk on the working years, right? That's a theoretical possibility. Mm-hmm. The other extreme is we're all only going to do the traditional. And so we're going to park our tax risk in either early retirement or late retirement. And even there, what we could do is Roth conversions in the early retirement or not do Roth conversions in the early retirement. One of the points we make in the book is let's think about the different profiles involved. And I'll shortcut this. Your 30-year-old self, your 60-year-old self, and your 90-year-old self. 30-year-old, like you were saying earlier, Jason, they could have 2 kids at home, a spouse at home, a mortgage payment. They can have attributes about their profile that make parking tax risk in that part of life very undesirable, right? Why are we increasing expenses when we got kids we got to support? That's a compelling need. We got a spouse, we got a mortgage payment. Or what we could do is say, all right, well, we don't want to put tax risk there. We'll get to retirement, say at 60, and we're going to do massive Roth conversions. Well, the issue with that is, let's call that the beginning of our retirement. If we increase expense in the beginning of retirement, we increase the odds of financial failure down the road, right? It's sequence. They call it sequence of return risk. Sure. Essentially, the early decade, depends on the commentator. I've heard 13 years. I've heard, but just say the early part of our retirement is a great time to not have expenses. Why? Expenses amplify, they call it sequence of return risk. Now, I do think sequence of return risk is sort of over worried about in the world, but it's not a nothing. So having tax risk in that part of retirement can be less than optimal. Well, all right, let's take an extreme view. And I'm not saying anybody should do this, but what you could do is do traditional at work, never do a Roth conversion, and now in our late 80s and early 90s, we're setting ourselves up for more tax risk. Well, let's think about that person, though. That person doesn't have the sufficiency concerns that a 30-year-old or a 60-year-old would have. That person might have tax inefficiencies. They absolutely might, but they're almost certainly in a great place to bear them. Why? They don't have the energy to be flying to the tropics, right? Their expenses are either going to be relatively low because they're low energy, or they can be mostly deducted on the tax return anyway. So I'm not here. I think a lot of folks should consider Roth conversions, particularly in the mid to late 60s. But I'm here to say, if we had to pick a time to park tax risk, I often like the later part of a retirement because we tend to pay less taxes because the Congress loves retirees.
Right.
But even if we don't, even if I'm wrong on that point, and I'm certainly not going to be 100% right on that point, we've parked tax risk at a time where we're probably not going to be spending that much anyway, because we just don't have the energy to. Our finances are probably in a good shape if we've built up really good finances. But if we are in long-term care, then a lot of those expenses are going to be deductible anyway. Right. So there's no free lunch. Right. There are downsides of parking tax risk anywhere in those three buckets: accumulator, early retiree, late retiree. But I do think it tends to work out that if we park tax risk in the later part of our retirement from a general perspective, either that person will only be moderately successful financially and their taxes aren't going to be that high. It's just the way the rules work. Progressive tax brackets, sure. A moderately successful retiree tends to pay relatively modest taxes. The very successful retiree later in life could have tax inefficiencies. They could be paying 32% on some of their RMDs. Right. What they have is not a financial problem. They have a tax inefficiency problem accompanied by almost certain high financial success. Right. So from a planning perspective, is it about winning the spreadsheet or is it about lived experience? And I tend to think we should bias towards the lived experience. Now, look, I'm not saying we can't do tax planning for the later part of our life. We absolutely can. We should think about some Roth conversions. There might be incredible Roth conversions on the table in our mid 60s, late 60s. I'm not here to say we should never think about tax planning that reduces our tax liability later in life. But I do think if we're just going to have a little bit of a bias, if we're going to have a bias that settles our ties when we're trying to make a decision on, say, the next 10,000 of a Roth conversion in our mid 60s, and we're like, I don't know, you could argue it this way, you could argue it that way. Right. Maybe you say, hey, the tiebreaker is where am I going to park this tax risk? And maybe it's better to park it later in life than in our mid 60s. So just some food for thought for the listener. I'm not here to say, don't do Roth conversions. That's not what I'm saying. I'm saying just think about where tax risk best sits. And I tend to think it best sits in the later part of our life, but that's something I think we should all be thinking about. Yeah, it's a great way of framing it. And I think too, it's who are you tax planning for? And what I mean by that, and I know you get to it in the book, right? Are you tax planning for you and your spouse now, or your spouse as they continue on after you pass away? Or are you tax planning for your children, right? I mean, these all play into
your approach to tax planning.
Yeah, and Jason, so that is one of the responses that I get where I say, a lot of times these traditional retirement accounts aren't that heavily taxed during the original owner's lifetime. A lot of times the response is, but what about the next generation?
Mm-hmm.
Well, I have a few thoughts on that. First of all, it is perfectly legitimate if mom and dad are in the 22% bracket and they know son or daughter is in the 37% bracket, they want to do Roth conversions to capture a 15% intergenerational delta, right? They leave a traditional IRA to the son or daughter, they're going to pay 37 cents on the dollar versus they pay 22 cents on the dollar, and they want to capture that and they can afford it. Great. Like, I have no problem with that. But I also don't think that's a compelling, I don't think there's no moral compulsion to do that. So what I mean by that is we contribute to our own retirement accounts to get us and our spouses to and through retirement. Mm-hmm. So when I was 32 years old, I changed jobs and I go, sign up for the 401k and I make the traditional versus Roth decision. I think we assess that based on what's most likely to get me and my spouse to and through retirement. Okay. I don't think we assess that based on my future kid, who may not even be born yet, or might be 5 years old. What is the tax that they're going to pay on that? Right. Mm-hmm. I don't think we assess that decision based on the speculative future tax liability of somebody who's not me or my spouse.
Sure.
The other thing I'd say is, are we so sure your kid's going to pay all this tax on that account? Maybe they inherit when they're 55 and they're on the verge of retirement and they say, oh, I just got this $500,000 IRA. You know what I could do? I could start living off that as my primary means of support in retirement. And all of a sudden they're going through the high standard deduction, the 10% bracket, the 12% bracket. They might pay less tax than you would on that retirement account. So, I just think I would argue sometimes in this conversation, we lose the forest for the trees. The tree being someone who gets a sizable asset might have to pay sizable taxes. They're still better off for having gotten that asset. Sure. Versus the forest of, I think the job of our retirement accounts is to get us and our spouses to and through retirement. I don't think it's to manage the speculative tax liability of somebody who's not me or my spouse. Sure. That's my opinion. And this is all subjective, to be fair. Right. That's my take on it. But I know other people approach it differently.
Sure. Yeah, I love it. And then, towards the end of our financial lives or end of our lives, right? I mean, there are these estate tax planning opportunities. There's gifting. The estate tax stuff, I mean, you got to be pretty fortunate if you're coming up to some federal estate tax thresholds, especially with the portability between spouses there and combining it. So
yes,
I don't think we'll go too deep down there, but there are those estate tax, and gift tax planning opportunities later in life, right?
Yeah. So a couple thoughts on that. One, you're right. Now we have a $15 million per person exemption for federal estate taxes. So a married couple, you mentioned portability. It's the greatest tactic for married couples to mitigate federal estate taxes. Essentially in today's environment, it would be 30 million of combined wealth you could leave to the next generation. Not a lot of folks are going to die with 30 million of wealth. Mm-hmm. But then you do say, it's funny, I think it's a handful of our northern states, and I believe Hawaii, although don't quote me on that, have state estate taxes.
Yes.
And these things, to my mind, the best time to plan for them is later in life. Because, I'll give you an example. My understanding is Oregon imposes a state estate tax at $1 million of estate value, which you don't have to be, a Rockefeller to have $1 million. Now, I don't find that compelling of a planning tactic, because in theory, you could be working with someone, they're worth 2.5 million, 3.5 million, they're in their mid 50s. Oh, but you got Oregon estate tax. So what? You're supposed to just give away $1.5 million before you've fully funded your own retirement? I think the best time to deal with an issue like that, and by the way, I think some of these state estate taxes will get mitigated over the next few years as constituents start knocking on doors and saying, wait a minute, I'm paying these estate taxes. But I do think the best time to usually handle those, because you don't want to be giving $1.5 million to the next generation to avoid this tax just in your 50s. I think the best time to plan for that is later in life, where it's like, look, financially, I'm good. And yeah, there's this estate tax issue. So maybe I start doing some planning or some Roth conversions to get some income tax out of my estate, or some gifting. There's the annual exclusion gifts. And this number always changes. I think it's 19,000 a person, and you can double up with spouses, and then maybe your kid's got a spouse. So I think it's like 76,000 between generation one, generation two, if they're both married. So that's something to think about as well. The other thing I'll mention is charitable giving.
Yeah.
A couple of years ago at a homily, I heard this concept and I was like, oh, this is smart. What you could in theory do with your IRA is treat your church, or you could do another charity, treat your church as just an additional child. So think about, somebody with a $3 million IRA, and say they're the surviving spouse. So, say usually it's the husband's already passed. So mom is the surviving spouse. She's got a $3 million IRA and 3 kids. Well, you know what she could do? She could just name each of the 3 kids as 1/3 beneficiaries. They each get $1 million of a traditional IRA. Or she could name each of the 3 kids and her church as 25% beneficiaries. So they'd each get $750,000. And the thing is, what she would have done with that is she would have taken $250,000 away from each of her children, but it would have been the highest tax $250,000.
Right.
So yes, they lose out. First of all, they're probably going to be just fine with the $750,000. They're probably going to be okay. They have their own earnings capacity and their own assets and whatnot. But by giving $750,000 to the church, she's reduced the IRA that goes to the kids by $250,000 each. But it's the highest tax piece because of the progressive tax rate. So in the book, we refer to that as the church IRA. I like that concept. So there's different things you could be thinking about. And then the last one is just location. If I want to leave some money to the church, some money to my kid, and I got a Roth IRA and a traditional IRA, and theoretically the amounts are the right amounts, leave the Roth IRA to the kid, the traditional to the church. You skip out on taxes that way. Don't leave the Roth to the church and the traditional to the kid, because now you created more tax by doing that. So there's little things that can absolutely be done. Especially in today's environment, when we think about estate planning, we're actually more thinking about income tax than estate tax. Years ago, estate tax was a much lower threshold, so people thought about it a lot more. But with the federal exemption going so high, it's not as pressing unless you sold the tech company or something like that, or you're a quarterback or in the NFL or something like that.
Yeah. I mean, there's just so much here. It's all great content, and I love we could just go on and on. RMDs and using charitable donations to do the tax planning around some R&Ds. So much here, and I appreciate your time. It's all been great. I think one last thing before we go is I kind of want to do a deep dive in one area.
Yeah, let's do it.
And by deep dive, I don't mean we have to go on and on, but let's talk about for the listeners, tax loss harvesting and the not so commonly mentioned tax gain harvesting.
Yes.
And maybe the great tools, but also maybe not as powerful as people may think due to things like capital loss carryover and some other things in there. They sound great. I'm a believer there is a time and place, but not necessarily a ace in the hole for the final piece of the puzzle, right?
Yeah. So first of all, when we're talking about tax gain harvesting or tax loss harvesting, we're only talking about our taxable brokerage accounts.
Right.
No Roth IRAs, no HSA, no 401k, no traditional IRA, none of that stuff. Literally our holding in our our taxable accounts. Okay. Tax loss harvesting. So this is, okay, I review my accounts and I say, oh, look, there's a loss in that account and in that particular holding. Mm-hmm. So what I could do is I could sell that and trigger the loss on my tax return. And then what I can do is either I can rebuy the same investment as long as it's been over 30 days, there's a 61-day window, 30 days before the transaction, 30 days after the transaction, where I can't rebuy, or to the extent I rebuy, the loss is disallowed and suspended, really.
Mm-hmm.
Okay, so that's a potential path where I could either sell that and then rebuy it later. It's got to be, at least a month later, generally speaking. Or I reallocate, because maybe I just didn't like that holding to begin with. So I pop the loss and I reallocate and improve my investment position. Now, some people these days try to structure their portfolio so that they'll automatically qualify. Sometimes this is referred to as direct indexing. So instead of buying ABC large index fund, they buy individual shares of most of the index. So they've got, Acme Company and Beta Company and Charlie Company, all these different individual equities. Well, even in a high stock market year, a year where the stock market's going up, odds are 10%, 20%, 30% of individual equities in an index are going to go down. Their sector's down. They got bad management. A competitor, was better than them, whatever it is. So what they do is they hope and pray, hopefully 10% of these equities go down in value, so then I can sell those and trigger the loss. But Jason, you referenced maybe that's not going to be the best planning. Why? Because of the limit that on capital loss utilization. Mm-hmm. So when you have capital losses, you can use them to offset your other capital gains. Mm-hmm. That's great. You might not have that much in capital gains, especially if you're an accumulator. You might just not be selling stocks at gains. Everything stays invested because you have no reason to sell other than to trigger losses. It can offset capital gains, and then it can offset up to $3,000 of ordinary income. So that's your W-2, your Roth conversion, your IRA distribution. That could be helpful. But I say, well, wait a minute. Who's the person who got to an early retirement or financial independence or whatever your financial goal is because they popped a $3,000 loss against ordinary income on their tax return every year? Like, I just don't know that person. And yes, the unused losses carry forward indefinitely to the succeeding years. Like, I get that. Mm-hmm. But I think it's of limited value. Look, in the right profile, it could be highly valuable, but and to the extent it's highly valuable, it's probably only going to be highly valuable for 1 year. But that's tax loss harvesting. And it's the sort of thing, look, if your portfolio's got a loss, you should at least be thinking about it. Okay, so that's tax loss harvesting. Tax gain harvesting tends to be a retirement play. So this takes advantage of the 0% long-term capital gains bracket, which, by the way, we've had since the year 2008. And by the way, I was listening to another personal finance podcast recently. They had a guest from New Zealand. New Zealand doesn't tax capital gains, right? There are other countries that don't even tax. There's arguments around that. I don't want to get into that today. But our 0% long-term capital gains bracket isn't as extraordinary as you might think it is. But okay, let's think about that. Long-term capital gains, 0% bracket, very valuable depending on the profile. And you could do two things with this. So you could say, oh, you know what I want to do? I've got, an old stock position or even a mutual fund position, and I can either reset the basis and then just rebuy. And by the way, there's the rule on the tax loss harvesting is called a wash sale rule. It's 30 days on each side of the transaction, 61 days total because you got the day of the transaction. Tax gain harvesting, that doesn't exist. You can sell it on the first day, and as long as you're not buying it back from your brother or your mom, you're just fine, right? You go back on a brokerage, they connect you with a third party, you can rebuy that. And they call that a basis reset. And so what that's doing is saying, well, I had this capital gain. Let me trigger it while I'm in the 0% long-term capital gains bracket and then reset my basis. And then later on, when I might not be in the 0% long-term capital gains bracket, I sell it at that point to fund living expenses, say, well, now because I got all this basis, I don't pay tax on it then either. Right. So that could be a great thing. Or it could be essentially a reallocation. So you say, oh, I worked for this tech company. Its stock went to the moon. I have this old employer stock. And what I want to do is I want to sell it and have that loss hit the zero, or have that gain hit the 0% long-term capital gains bracket. So I'm not paying federal income tax on that. And then what I'm going to do is take those proceeds and buy a diversified holding. And that diversified holding will now have the step up in basis, and I've improved from an investment perspective. So that's another play on the tax gain harvesting. I think they're both things that it's helpful to know about. But I will say they're both of a little bit limited value. And then sometimes I get this question, should I do a Roth conversion or tax gain harvesting? That's a question that seems to come up. And look, I tend to bias towards, if you're going to do one or the other, but not both, then I would generally be biased towards the Roth conversion. I say that because with the 0% long-term capital gains bracket, the original owner may never pay cap gain on that anyway, because they might, when they need it for their living expenses, might be in the 0% bracket. Right. And that person might just die holding it, and then it gets a step up in basis at death. Traditional IRAs never get the step up in basis at death. Right. Now, I will say this, though. If you're in a traditional IRA that's got a nice diversified holding and your taxable account is all in one tech stock, I'd probably favor tax gain harvesting over the Roth conversion for investment reasons. And I think those investment reasons are more compelling than the tax reason. The idea being, hey, let's use the tax gain harvesting angle to efficiently reallocate into a more diversified holding. And yeah, the traditional IRA's got its drawbacks, but at least it's in a diversified holding, and we'll figure out some tax planning for that later on.
Sean, all great stuff. I appreciate you coming on here. Our guest is Sean Mullaney. The book is Tax Planning to and Through Early Retirement. Again, Sean, thanks for coming on. It was a great conversation.
Jason, it was a pleasure being here today. Thanks so much for having me. I greatly appreciate it.
The opinions and statements presented on this show are for general information only and are not intended to provide specific advice or recommendations. Never make any investment or financial decisions based on information offered on this show without first consulting your financial, legal, or tax advisor. All economic and performance information mentioned on the show is historical in nature and is not indicative of any future results. All indices mentioned on this show are unmanaged and cannot be invested in directly. All information is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Lastly, all opinions expressed by Jason Katita and any guests on the show are solely their own opinions and do not reflect the opinions of or are endorsed by Toba Financial. For Jason Katita, investment advisory services are offered through Toba Financial LLC, a registered investment advisor offering advisory services in the state of Hawaii and in other jurisdictions where exempt from registration.